The bond market often operates as a barometer of economic conditions. And in recent times, we've seen how the market itself can force the hand of monetary authorities. When central banks like the Federal Reserve hesitate to tighten economic conditions, the market may step in and do it for them. This has become especially clear as interest rates continue to climb, with the market signaling a strong desire for higher rates. Everything, from the price of gold to the strength of the dollar, seems to be locked in a delicate balance. And every asset class is now being judged against the almighty dollar. But how does this impact Bitcoin and other digital assets? Well, Bitcoin has long been viewed as a leading indicator of dollar liquidity due to its 24/7 trading and responsiveness to global events. In fact, recent Bitcoin volatility may be linked directly to changes in interest rates and liquidity conditions. As the Federal Reserve began making moves, cutting rates in particular, it sparked a debate among financial analysts. The main question, how do interest rate cuts affect dollar liquidity? The answer is not straightforward. Some argue that lower interest rates push capital out of more liquid markets, forcing it into other investments and affecting liquidity in unexpected ways. This conversation recently took center stage in a podcast interview between Jack Mallers, Dylan LeClaire, and financial expert Bill Meers.
But his point is that money market fund managers, which, money market fund managers manage a lot of the dollar liquidity in the world, and the reverse repo, the RRP yields 5.3% is what he writes, and funds will be invested in T-bills if their yield is slightly greater. Starting mid-July, the 3-month and 6-month T-bill yield dropped below the RRPs. That the money market fund started rotating their assets into different instruments that were more bearish liquidity.
They dug deep into the impacts of monetary policies on markets, especially focusing on Bitcoin, interest rates, and the broader financial landscape. Jack pointed out that we are seeing strong year-over-year gains across various asset classes, from stocks to gold to real estate. Dollar Bill, as Meers is affectionately called, noted that trading long in this environment still makes sense given the broad market gains. But how much longer will this bullish trend continue? The interview highlighted the critical roles that both the U.S. Treasury and monetary authorities play in managing liquidity.
I just think, come on, Bitcoin is 14 years old, but only 10 or 12 of that where it really had enough liquidity where where Mount Gox wasn't, the bellwether. If you want to look for liquidity, I say you got to look at. I would start with gold, and that's mine. That's what. That's your dollar liquidity story, right?
And the potential consequences of their actions or inactions. Treasury Secretary Janet Yellen's strategies, for instance, could shape the future of liquidity with significant implications for all markets, including Bitcoin. For example, money market fund managers who control much of the world's dollar liquidity are now navigating a tricky situation. The reverse repo RRP facility is yielding around 5.3%, and recently, short-term Treasury bill yields have dropped below that level. This difference in yields has led to a rotation of capital between these facilities, a move that has important implications for dollar liquidity. When Federal Reserve Chair Jerome Powell recently hinted at potential rate cuts, it caused investors to adjust their portfolios. Bitcoin, often the first asset to react, saw its price dip following Powell's comments, and even the S&P 500 began to feel the impact. But this reaction may have been tied to broader concerns about liquidity, as Jack Meers noted. In his view, Treasury Secretary Yellen will need to step in soon to stabilize liquidity, especially as we head into an election year. Political motivations aside, a significant market downturn would be risky. Yellen has already shown that she is willing to intervene when necessary, and Bitcoin traders are paying close attention. Arthur Hayes, a former Bitcoin trader and outspoken financial analyst, had even shorted Bitcoin in anticipation of these liquidity concerns. However, he closed his short position recently, betting that Yellen would indeed provide the necessary liquidity to prevent further market declines. Sure enough, Bitcoin rebounded by 2 to 3% over the weekend, demonstrating once again how quickly it can react to changes in financial conditions. This reinforces the idea that Bitcoin often acts as an early indicator of liquidity shifts before other assets follow suit. Now, the broader market is reacting to this fluid environment, with ongoing speculation about the Federal Reserve's next move. The bond market itself is beginning to punish monetary authorities. As Jack Meers noted, if central banks refuse to address these challenges, the market will step in and force their hand. We've already seen this happen when Treasury yields hit 5%, prompting Yellen to make critical adjustments. But the overarching question remains, what happens next if yields climb to even higher levels, such as 6%, 7% or more? The market could demand higher returns, forcing the government to react. And when the market demands action, the consequences can be swift and severe. The bond market has long been a focal point for those seeking clues about broader economic trends. When Yellen stepped in to inject liquidity late in 2023, it marked a significant moment. Her intervention helped fuel Bitcoin's dramatic rise from $20,000 to $60,000 and beyond. It was a clear sign that when liquidity flows, assets like Bitcoin benefit the most. But if Yellen and Powell don't take the necessary steps, the market will tighten conditions for them, leaving little room for error. This dynamic, which has been in play for several years now, continues to shape the financial landscape. As Jack pointed out, this is no longer just about interest rates. It's about how central banks manage liquidity across the entire financial system. Arthur Hayes' insights into Bitcoin, money markets, and liquidity add another layer of complexity. Money market fund managers are actively shifting capital between different facilities based on yield, and this is having a direct impact on dollar liquidity. As Powell hinted at rate cuts, investors responded by moving assets, and Bitcoin took the brunt of that initial adjustment. Yet Yellen's next move could be even more significant. With the potential for a major market downturn on the horizon, it's crucial to watch how the U.S. Treasury handles liquidity in the coming months. Jack believes that Yellen will need to act soon, particularly given the political stakes in an election year. No one wants to see the markets crash just as voters head to the polls. In the meantime, Bitcoin continues to behave as an early warning system for liquidity issues. As liquidity concerns rise, Bitcoin prices tend to dip. But as we saw over the weekend, it doesn't take long for the market to correct itself, with Bitcoin rebounding as investors adjusted their expectations. Meanwhile, the debate over gold versus Bitcoin continues. Bitcoin advocates argue that Bitcoin is the superior store of value, thanks to its fixed supply and transparent issuance schedule. Unlike gold, we know exactly how much Bitcoin will be in circulation at any given time over the next century. This level of predictability makes Bitcoin an attractive alternative to gold, especially in an environment of fiat currency debasement. Many analysts are now eyeing an October breakout for Bitcoin, despite the current market slump. Bitcoin ETF outflows in the US may be causing short-term pain, but the long-term outlook remains bullish. Some analysts are predicting one final correction before Bitcoin embarks on its next parabolic phase. Could this be the last dip before Bitcoin's next surge? Mags, a popular crypto analyst, believes that Bitcoin's next major price movement is imminent. According to her analysis, Bitcoin has been forming higher highs and higher lows since February 2024, signaling a long-term uptrend. However, she anticipates a potential correction towards the $51,000 mark before the next upward move. Other analysts, such as Titan of Crypto, share similar views, suggesting that Bitcoin is wrapping up its consolidation phase. With multiple experts predicting a last dip before the next leg up, the coming weeks could be critical for Bitcoin and the broader cryptocurrency market. As we close, remember that the financial world is always evolving. Whether it's the bond market, central bank policies, or the latest movements in Bitcoin, staying informed is key. Please share your thoughts on Bitcoin, dollar liquidity, and the bond market in the comments below. Don't forget to like, share, and subscribe for more in-depth analysis.